So today on this panel, we're going to be speaking about private equity in 2024. Yesterday, I don't know what happened to my camera here. Oh, well, there we go. Yesterday, I led a discussion on mergers and acquisitions, and in my view, they're inextricably intertwined, these topics. So for the benefit of the audience, I'm going to try to really steer this conversation to be a little bit different. We'll say yesterday was we really focused on the transaction, right? We really focused on how the transactions get done. Today, we're going to be talking more about investment and holding portfolio companies and working those sorts of angles. So it should be a little bit different, but obviously there's going to be some crossover and there'll be some discussion you hear that you may have heard yesterday if you were in the room. Here are a few things to think about from PitchBook. Positive signals through 2023 will spur a comeback in IPOs in 2024. Perhaps Reddit is that indication that things are going to begin to loosen up a little bit in that area. U.S. VC funding is expected to increase, making it stronger than 2023, but probably not the heights that we had in 2021, 2022. U.S. active unicorn count and aggregate post valuations will decline in 2024. So that's sort of on the negative side, and flatter declining interest rates in 2024 will lead to an increase in U.S. Deal activity with non-traditional investors participating in it. So to help us sort of discuss these topics and make sense of this whole thing, Marty has gathered a great panel here. We have Ben Brandes. Ben, if you could give a little wave or something, thank you. Timothy Smith, who was a CIO of a family office, Petro Lucrum. Russell Deakin, who is the CIO and managing director of Aceana Group, another single family office. Ron DeArvey, who is executive chairman and chief investment officer for NewOak, who was there in person, and Scott Cheskiewicz, partner at Jackson Walker. My name is Mark Heil. I'll be moderating this panel. I'm managing director with Pickwick Capital Partners, a FINRA registered advisor to middle market companies and alternative asset funds. We help with investment banking services and help raise funds, both public and private. For the next hour or so, we're going to have a great conversation up here. I invite the audience to participate. To the extent you interject into the discussion, I would ask that you keep your comments to, be as brief as possible. Get to your point and ask. If we need more context, these are very capable people. They can certainly ask, for more context. With that, and having a lawyer on the panel, I'm going to read a quick disclaimer. Information presented here is for educational purposes and is not intended as and may not be relied upon as tax, legal, or investment or other types of advice. To the extent myself or any of the panelists expressed their opinion, they're our opinion and not necessarily the opinions of their firms. So with that, let's move on and start having our panelists introduce themselves. And Ben, if you would do us the favor and start us off and talk about NewOrigin investments, be most grateful.
Thanks, Mark. It's great to be here, and Marty, always love these events. So appreciate you having me on the panel. And Mark, I also want to mention to you, thank you for calling me capable. I think you mentioned the panels were capable, so that's the best compliment I've heard today.
Well, that clearly was a modest description.
Ben Brandes, I'm a founder and partner of NewOrigin Investments. NewOrigin Investments is a healthcare platform investment company that invests in health and wellness geared towards the aging market, because I hear that people are aging. So just to give you a sense of what that looks like is a lot of people are familiar with home health care. And I also look at mobility companies, communication companies that allow family members and their loved ones to age more gracefully in their homes. And I'll tell you that, I hear a lot of comments about the stats of deal flow and pick up on investment banking and things of that nature. All that, when you invest in the aging market, is not as important. The reason being is because the demand for services in the markets that I look for outweigh the supply to such an extent, especially in the US, especially in certain areas of the country, that timing is not as important in your investment thesis. So hence a great area to be. And thanks. Happy to be on this panel.
Yeah, that's really interesting that timing's not as important for these investments. Could you just elaborate on that a little bit? Why that's the case?
If I can tell you that most people that I talk to, and I'd love to hear stories, the panelists and other people about parents or loved ones, that there's one issue or another that they've had moving into a facility, staying at home, coming back from a hospital, and the doorways aren't big enough in the home, communicating with doctors, loved ones, family members. So regardless of the price discrepancy between sellers and buyers, between what is happening with inflation, there's always going to be something that is needed because our population is aging to such an extent, even more than what you can imagine. So that gives fertile ground for investment opportunities. Just a couple of stats real quickly, and then I'll move on, is that in this country, we just broke the record for the amount of people who are 65 years old this year, 4 million. 10,000 people are turning 65 every year. Disposable income is increasing. Wealth is increasing. Inheritances are increasing. So again, I mentioned the word fertile ground for the investment. So yes, I always worry about timing from month to month, maybe in terms of, talking with sellers and founders of companies, but not so much on the bigger picture because I just know the market is in my favor.
Excellent. Thank you. And it's one of Marty's favorite pet topics. So he's going to be very interested in having some further conversation with you. Timothy Smith, if you would do us a favor and just introduce yourself and your family office and tell us about yourself.
Sounds good. Good to see you again, Mark. Calling in or videoing in today from Houston, Texas. Wish I was up there for South by Southwest with everybody, but between all of the rodeo stuff and other things, it's been keeping us pretty busy, but I digress. My role is Chief Investment Officer of a G4 single family office, wealth creation in agriculture and energy, kind of a Texas story in terms of reinvesting that liquidity into oil and gas. Going up to about 10 years ago, a heavy concentration in upstream oil and gas, really used the unconventional boom and a number of the other influx of capital to further monetize and diversify the portfolio. That led me to joining as the investment officer in 2016. Since then, we've been going through generational diversification strategies, which of course means different things for everybody. But from our perspective, the next gens are not necessarily stepping up to, say, take over family businesses or interests, or even get very heavily involved in the investment process. So while historically we've had almost 100% concentration in direct investments, over the last 6-7 years, we've moved to about a 35-40% outside managers, alternative investments, which kind of includes your preservation of capital strategies, your fixed income for family income, and then being able to further diversify across different segments. But we still have a very active direct investment program, which has allowed us to get sector diversification outside of energy and industrials through co-investment with other partners. So private equity is really kind of our sweet spot, and we're excited to talk more about some of the things we're doing as we go along. So thanks for having me, Marty and Mark, and excited to be on the panel with everybody.
Thanks, Timothy. You can let the family know I'm available for adoption.
Boy, I think they might have enough dependents already, but I'll make sure to pass that along.
Russell, I see you're still challenged by your video here.
I am. I failed the IT test, gentlemen. It's never happened before. So, if you travel long enough, or if you do enough panels, you sometimes get the one that's not working. So today happens to be the one. So I'm behind 5-0 on the IT, unfortunately, and don't seem to be resolving unless leaving it. So my apologies. And as a middle-aged guy, I guess I'm not that good looking anyway, so no one's missing that much. But just a little bit about myself. I'm a founder of Aceana Group. It's my single-family office. We, as a family, we're a British-Brazilian family. We're actually, the last 17 years, have lived in Miami. Although I have something in common with Timothy. I actually went to high school in Houston, so I know we've chatted before in the past. So, but we have a focus. We have two operating businesses, which is we have a real estate developer, commercial, residential in Brazil. And we also have productive farmland, rice and cattle. So that provides us yield. And I was actually a founder, a partner of Latin America and Brazil's oldest venture capital firm many years ago. And then 2006 started doing investments off my own balance sheet. So on a private equity side, we have the ability to, I guess, to go for a little bit more alpha seeking. So we generally do growth capital and venture capital. And we have exposure in Latin America, in the US, in India, and in Singapore, as well as the UK. So we're fairly global as well. We do directs, we do co-investments, and we do fund investments as well.
Fantastic. Are any of the geographies more attractive to you than others?
Certainly. I mean, it's also a price point. And I think what we have if you look at the US, generally the US 50, 60 years or so has been the leader in private equity and private investment venture capital. I think one could say that it generally started here. But what you're seeing now is there are opportunities. Everyone's on a different time frame and a timeline. So it's a question of macroeconomics, demographics, as well as price points. So something new the last 2 or 3 years, I went to India on a business trip 4 years ago and said there wasn't enough distribution, but now there is. So we committed 2 years ago to, actually a year ago, to an Indian fund manager, because I think India, now with what's going on in China, is going to be a big beneficiary of more capital, more diversification, more liquidity. So we've done recently investments in India and Singapore. Southeast Asia is not quite at the same level yet as India, but we think those are two markets that the next 10 to 15 years are going to have very good macroeconomic tailwinds. There are still excellent opportunities in the US and in some places of Western Europe, and we will continue to do that. But I would say slowly but surely, if you look at the whole pie, the US percentage of that whole pie has diminished slowly over time and will continue to be diminishing, although the US will still be the biggest private equity venture capital market going forward.
Fantastic. Appreciate that, Russell. Ron, always a pleasure to see you. Tell us a little bit about yourself and NewOak, if you would.
Good morning. In short, I am a reformed financial engineer, or an engineer by background. My first career was essentially looking at the future of aviation and building the most incredible ideas at McDonnell Douglas. That led to me to move into financial engineering at a very, very fortunate time, 1994, where you had fully realized that the banks should not be where majority of finance should reside. And that was the beginning of what I consider securitization revolution. And the interesting part about that is that everything in life leads to some sort of financing. And ultimately, I like to cheat, meaning look at data. Where the rubber meets the road is where those instruments ultimately realize into vehicles. And that was the beginning of the journey of 2000. So by definition, you cannot be in structured products and not be an engineer and not be into developing forecasts and looking at the past data to predict the future. And that's really where I think I found a huge advantage over my fellow soft side of investment world, because they were more or less relying on a lot of Fed-driven data, and we were able to actually look at asset class, look at, consumer finance, commercial real estate, corporate, asset-based lending, supply chain, and all of that one by one it started showing up into the marketplace. One thing that surprised me the most was when I actually was asked to create a divorce fund as well, which actually we successfully managed to make some money. But even in that era, you'll find that when people need money, they'll find a way to be able to do that. So that led to the securitization wave, which led to credit default swap and led to the financial crisis of 2008. And I happened to be at the right place at the right time, trying to figure out what the heck just happened at BlackRock. And then that gave me the idea of start what I consider a single manager a vehicle called NewOak Capital. NewOak Capital is, you're looking at the guy, so I cannot say that the views of my self is not the view of the firm. It is. And that has become really what I consider trying to solve the issues of securitization market as I saw it. That we had many parties that were contributing, but nobody was going to take the ultimate lead when things go bad. Everybody is ready to take their fees, but nobody is willing to, in fact, restructure them. So NewOak Capital was started with restructuring those vehicles in a very, very opportune situation, both as a referee, if you want to call it, that's called expert witness in the legal market, and then we started really looking at a cradle-to-grave solution beyond securitization. So where you're looking at right now is my vision, and the company's vision is to be able to bring in information on an instantaneous basis on the flow of capital from cradle to grave, including when sugarcane is first planted to when it's delivered to Cargill and when ultimately it's consumed, and that really gives you the technology here. And when I was actually watching NVIDIA's CEO's thing, he said, they have to think about where the hockey puck is going, not where it is. And I really do believe finance as we know it will be revolutionized and restructured many times away from the balance sheet of the banks. We've already seen that with several banks not being able to withstand the departure of deposits. So I'll stop there. I've already I told you the path and the kind of comments I'm going to make. I think growth is the story, even though people think about structured finance as being income, because that's where you really understand the ideas that are coming together. The sustainability, green technology, everything that you guys do ultimately will hit finance, both in the technology side and how you're able to put capital to work and be able to do that with the knowledge that you're seeing what's happening in the movie as it's developing.
Great. Thank you very much for that, Ron. And certainly I think, that point you brought up about finance will be restructured several times and banks and all that. It was a hot point of discussion yesterday during our M&A conference, M&A discussion, particularly with, some of the fintechs that have been shut down by or we're told that they could no longer operate in the banking sectors. So thank you for that, Scott. Looking very much forward to hearing about your practice, what you do, and who you help. So if you give a quick introduction of yourself, I'd be appreciative.
Sure. I'll try not to repeat myself from earlier today, but my name is Scott Cheskiewicz. I'm a partner at Jackson Walker. Been practicing law for 25 years. Started off as an M&A attorney along with some finance. But for the last 17 years, I've been representing institutional investors in things like private equity funds, as well as other alternative assets. My clients tend to be large pension plans, state governments, foreign governments, sovereign wealth funds, university, public and private university endowments, a couple insurance companies, and some family offices. And I'm here today, hopefully, to talk about continuation funds, a relatively new development in the private equity fund space to deal with longer term or zombie assets.
No, I think that's a fascinating conversation, continuation funds, and we would definitely be jumping into that and also talking about secondaries and other things. So let's get it underway, and let's start off with a few, a few statistics. Ron says he loves data, so let's start off with a little data. Private equity over the last few years, it was at 2.2 trillion in 2021. 1.7 trillion in 2022, and came in at 1.3 trillion in 2023. So with this background, are we going to continue to see a decline in private equity, or do you expect a rebound in 2024, 2025, and so on? I don't know who wants to field this one first. Ben, do you want to kick us off here?
When you say 2.2 trillion, I'm sorry, is that the value of deals that have been transacted?
That's correct. That's deal volume. Yes.
Okay. I want you to have a different stat.
Good.
How much dry capital is out there?
There is a lot of dry capital out there.
Yeah.
Now, that's an interesting topic all by itself, right? Because dry capital out there, maybe Scott wants to join in this conversation too, represents the amount of committed capital that's yet to be deployed. And we saw back in 2008, a lot of fund managers were told not to draw down that dry capital, right, by the limited partners, because they were dealing with the denominator effect. I haven't heard any of those stories in the current markets, but, is it really out there? Is that a phantom number, or is it real? And how real is that?
Yeah, Mark, just a comment on that. I mean, you got to drill down in different markets. So, just the dry powder is in the whole universe. However, is the dry powder, for example, looking at growth capital in tech, if you go into the sector focus, its percentage of dry powder definitely varies depending on which country, which market, and whether we're venture, growth capital, large buyout. So I think we have to be a little careful of large macro numbers. I don't think dry powder is a particular problem at the moment. I think there's other issues where you could say that some of the markets have more of a challenge. I think has been the adjustments, but there are certainly opportunities. There's been adjustments, obviously, in some of the valuations, given the interest rates, especially on growth capital on a smaller end. You can say that there's been some quite substantial adjustments in values, but that makes fundraising harder for some of the funds. And where I've seen that something that hadn't happened in many years, we've been able as a family office to get into the final close of funds in which we've been offered still primary values of paying par value, but the portfolio has been invested, and some of it quite substantially. And there's been, let's say, a markup of up to 1.5%, even up to 2%, two times on the value of the portfolio. And they are still giving opportunities for us as LPs to get in, sometimes at par, paying a little bit of catch up. So the difficulties in the markets have created opportunities to get into certain very good funds with more mature portfolios at very attractive levels. It's almost a financial arbitrage.
I can make a quick comment on that. Is my entire career has always been, the difference between greed and fear. I would say that in 2022 and 2023, the markets were driven by primarily fear, because you could tell, almost everybody in the private equity side was alarming us and, what sort of situation we're going to be facing. And I think the fact that none of those dramatic situations and bad scenarios occurred, or if they were occurred, the Fed was smart enough and fast enough to solve that. I think we're shifting now from a fear to greed, and that 2008 was a very good lesson to me that if you think too hard and don't act fast, you're going to be left at the altar. And that's what I think in the next 2 or 3 years, with the global growth in India, in Africa, in Southeast Asia, the shifts that are going on, even in sourcing, manufacturing, insourcing, with the sustainability opportunities, we're going to get through this, and we're going to find that, and we got to look at where the hockey puck is going. So I happen to be very, very positive. The ones who survive, they're gonna thrive. That would be my comment on that one, because I think
Great.
that's
Great.
Yeah.
Can I just add something here? Like,
I was going to ask you to.
okay, great. What I maybe present a little bit different view, because my information on this is usually secondhand, coming from clients and other folks like you. But what I keep hearing really it is fear, and it's obviously the record increase in interest rates, right, that made everything more expensive to deal with. But also we had, just before that, record high prices on companies, right? So valuations were extremely high, and nobody really wanted to take that huge discount on the sale side. So there really weren't that many willing sellers and opportunities available for a while, coupled with, the increased costs of financing and leverage for the buyers. And so most people, and I would say this was true in real estate as well as private equity, took a wait and see approach. Like, very few people wanted to buy too high, especially with debt being so high. And I think a lot of the folks also thought that the interest rates would come down faster. At least they were hoping that was the case. And so or at least stabilize, right? But they kept going up and then maybe held for a quarter and then up again. And so, nobody wanted to buy into a rising interest rate market with high valuations that or that maybe delusional sellers at this point were not willing to reprice their companies. And I think eventually that can't sustain forever, right? So either interest rates will come down or they'll stabilize, which it looks like is happening. And sellers are going to have to face the reality that they're just not going to get what they could have gotten 2 years ago. And when those things happen, you will have an increase in activity.
Right.
Excellent. Thank you, Scott. So just to throw a couple numbers out here for people. One is, Ben asked the good question, what is the number? And I'm going to quote the PwC in Prequin saying dry powder's at $3.9 trillion. Okay. Now something that sort of correlates to that is Bain threw out the number 3.2 trillion as the unrealized value represented by 28,000 unsold companies weighing down the private equity portfolios globally. So those numbers are almost the same there, which is kind of interesting to me. And of course, 40% of those companies, those 28,000 companies that are on the books of private equity, is they're 4 years or older. So they've been in the portfolio for a while. They should be baking. They should be ready to get out and be sold. But I think Scott's point that he raised a minute ago about this, the gap between what the sellers want and what the buyers are willing to pay has been slowing that process down. And my question, I think, was, do we see a break in that? Do we see that, in 2024, some, exit markets loosening up and for people to start buying? I think there's some indications that, we're stabilized with interest rates now. You may or may not believe that, but so anybody who'd like to comment on that, feel free to chime in here.
Yeah, Mark, just one thing that I've noticed. So I didn't know the total dry capital. I figured it was between 2 and 4. So the amount of dry capital is double the M&A activity, approximately. So there's enough dry capital to last almost 2 years without anybody raising any more money. That's a tremendous amount of money in the system.
So why isn't it being deployed?
Opportunistic.
It doesn't explain why it's not being deployed, though.
Well, I don't want to buy today at 80 when tomorrow I think I could have gotten 60. right? I mean, that's the flip side of what I was saying before. I think everybody was waiting for a big repricing to occur that really hasn't occurred yet. So they're waiting for that to happen. I know that's true in the commercial real estate space. We have a lot of commercial real estate fund clients that are just starting now to like really dig into finding, like, there was like a period of time they weren't even looking for opportunities because everything that they saw was that nobody was willing to reprice. So now, you know, the desperate folks are finally willing to come to the table and reprice, and we're starting to see an uptick in deal activity. But I don't want to, like, you know, overpay.
I think we've seen it in the healthcare space where people came up with rounds that were new notes rather than priced rounds, right? So we have been flooded with note offerings to be repriced 2 or 3 years later because nobody wants to take a leg down.
You also need to consider the capital that is not easy to follow, and that is, if you look at the oil-producing countries and mineral-producing countries, even in Africa, many of them in the past they were taking the same money and just doing same old, you know, income-driven real estate and so on and so forth. But the number of conferences that are being held right now in UAE, Saudi Arabia, even Kazakhstan, or various parts of the world, they are people who would not touch startups. And they only would go with Blackstones of the world, and they're forming new funds to do direct investment. So there's a lot of formation that hasn't really fully gelled in. They're amassing hundreds of billions of dollars. If you went into COP28, I don't know how much of it is, illusion, but I think that idea of digging out of the ground and building buildings is now transforming to digging out of the ground and building something that could multi-generationally impact the region. So I think that is and then that capital can be very aggressive and very long-term thinker. So I think that will come because they're hiring the same sort of talent out of here. They put them in the IFC, and the machine is moving maybe a little bit away from New York City, but the reality is that is a driver in my view, and I have a full view of that because being a conference junkie, I get to see it. So how much of it translates, but it is something, it's a good gauge. It's a good gauge how many people show up in droves to go there to participate in some of these the future, deep tech, and that will. So again, you're going to look at the opportunities. If you're trying to invest in the same exact old thing that you have. We have an example, Timothy, in our panel, his family has made a generational move, correct? Maybe I'll let you explain that. I think that was a very good example, eye-opener for me.
Yeah, happy to elaborate on that and talk on a couple of these key points. With the family's history, they did what they always did best, right? So first generation, second generation, that's always been the mentality. But I would say not just because we're multi-generational, but there's a big trend out there. I think most of you guys would agree that next gen just aren't necessarily trying to follow in those same kind of company footsteps. And so I think that is a big trend, and I've heard that quite a bit. And of course, we have a significant concentration even today at 55, 60% of the portfolio being direct investments. But we've been able to build a very diversified co-investment ecosystem to allow us to do that. But the challenge, as you pointed out, is starting to reallocate capital from a generational perspective and to be able to get familiar with these other types of asset classes. So it's been an interesting journey with private equity, for example, because we do direct deals still, but then we also allocate to funds, including private equity. And I think that there's an interesting dynamic occurring on both sides right now. One, as you guys have pointed out, enormous amounts of dry powder. Deal flow has slowed, interest rates being a big culprit of that in general. But I feel like Intelligent Capital is still able to negotiate or structure the deals in this environment. And lots of things that I've seen many of you guys use as well as we do, such as earnouts or various other structures that protect from downside when there's still market dynamics in play, but also share that upside, are usually great ways to make this happen. And I think the other thing that's really interesting and worth pointing out is just the overall sheer amount of these businesses coming to market now because of these kind of trends or shifts, right at a time where obviously there's a lot of dry powder, but the next gens aren't necessarily taking these over. So family-run enterprises, looking at whether they're portfolio companies or single enterprise type of families, the need for that is coming up. So I think structure really takes care of that. The other thing that we're doing, or I would more so that we're exploring, is include in a way to improve our own deal flow as a direct investor by using fund partnerships, LP interests to allow us to gain more access to their expertise as well as to their co-invest. So I'd be love to hear from some of the other family offices or panels how they're starting to utilize some of these tools. But we see both alternatives such as private equity as an interplay with our direct investment portfolio, so we can still get the type of return profiles that we may like to have, but not continue to have the same risk profile without, in the case of second gen being very active today, maybe in the next 10, 20 years, that not being the case.
So
Russell,
I like to
think he
just
threw it out to you, so pick it up.
Yeah, I'd like to sort of parallel with what Timothy is saying. So on one way, I would say I'm G3 of G4 on the real estate side. So that's something that we've been doing for many, many years. But then we've already started adjusting. 30 years ago, we bought our first productive farmland. So we grow rice and cattle in Brazil. So southern Brazil is like Texas without the oil. We're not quite as rich. But there's certainly opportunity in the land development has done well. And then I've been doing investments in technology for 25 years. I actually started speaking Portuguese to you just then because I was thinking about Brazil, but 25 years. So I think there's certainly something to be said that you can make these generational shifts. Certainly investing. I like to say I'm now G1 or G2 in terms of doing technology. I now have sort of grown-up sons and they're investing with me as well. So there are larger trends that you can see. I certainly think the larger trend is between commercial and residential, and the challenges, I think we're all going to be facing that. That's a longer-term trend. Technology has been very, very good to us. We were one of the first investors in the equivalent of the Web Navigator Explorer, but in Brazil became Terra Lycus. And that was a $12.1 billion M&A transaction in 2001. I do like to say that we did get crammed down 3 rounds before that, so I didn't get enough money to either buy a Formula One race car team and waste all my money, or buy a soccer team, which would have been Manchester United, which I guess would have been worth $6 billion. So I'm not sure which one I would have done, to be honest. Hopefully I would have made the right decision. But so, I think there's adjustments. So technology, we've been investing in technology for 25 years. I think we invest in verticals with funds that have a lot of experience. So we've done AI, we've done deep tech, we've done blockchain, we've done fintech, we've done ed tech, digital health, life science, med tech, and recently also space tech. SpaceX we did about 4 or 5 years ago. So these adjustments, I think you go down, you start in a general larger vertical, whether it's technology, and then you go into the different smaller sub verticals and you drill down, you find funds and teams that have been doing it a long time. Being good investors doesn't mean it could be a first-time fund, but not a first-time investor. And we, perhaps similar to Timothy, as a family office, we've had a lot of success doing direct investment, co-investments with these fund managers, getting the best deals and getting very favorable terms because we've gone further down earlier. If you give you guys one statistic, which I think is amazing, Uber went public, I think, at $53 billion. If I remember correctly, Google went public at $1 billion and Apple went public at 300 million. Just think about that. That's pretty amazing. So we've gone to go to alpha. We've done more Series A and seed and gone earlier to get the alpha. It's paid off handsomely for us. And with these fund managers, smaller fund managers, we've been able to get into the direct deals, whether it's a Series A, Series B, they don't have the pro rata necessarily, they don't have the capital to do it all. We're friendly, family office money, they like us, we come in, we can make decisions fairly quickly. And I think it's been a very good strategy, and those adjustments we've taken over the last 10 years because we saw that there's more value at the beginning. We've also continued to invest in tech. And then 6 years ago, I bought a book on blockchain. My son and I bought the book the same week. He was finishing Notre Dame. He came to Miami for the summer. He enjoyed his summer. I read the book. And so we started doing that. So you can add to your portfolio of expertise and verticals that you know within the general tech fund or commercial or residential. And I think we're constantly learning, and that's what makes our jobs and so interesting in the markets, because there's always going to be opportunities. You need to be flexible and continue to dig in. We invest, just summing up, we invest in people. Good people make money in bad markets and good markets. It's a question of pricing, and we'll continue to do so.
Russell, I want to just follow up on that before I jump over to Scott. I want to ask you specifically about ag tech and what you're seeing there, and are you excited by that area? Because it seems like it's an up and coming field.
It is. We have, I guess we've applied ag tech so far as more as a user, because we have the farmland, we grow rice and have cattle. And we're looking at technology, how we can benefit from that on the farms. I have not at this stage yet, but maybe some of the other panelists would be able to talk more directly about that. As of yet, we've looked at, but I have not pulled a trigger on investing in a fund specifically in ag tech or doing direct deals. Since it's one of our operating businesses, just as real estate, we tend to look at that. The bar's a little bit higher because we have, if I look at my portfolio creation, we have overexposure already to agriculture and to real estate because of our operating businesses. So I'm generally a little bit shyer to adding aggressively in that on a private equity basis.
Great. Scott, I want to come back over to you because we were talking about the 28,000 companies that were, currently in private equity portfolios. And one of the solutions to that, of course, has been secondary funds and also continuation funds. So I'd like you just to chime in here and tell us a little bit about what you've been seeing and what's been going on.
Sure, that's a great segue. With sellers, which include funds, right, not wanting to sell these companies at lower pricing than they think they're worth, you have the problem of funds coming to the end of their term, right? And so they can be extended with votes, et cetera, but there comes a point where that may not look very attractive. LPs get upset. And the concept of the continuation fund came along to really deal with that problem. And it's got a lot of great things about it, but I'm going to focus mostly on the negatives today. Because I'll just say right away, yes, it's great to have liquidity. It's great to have an exit. They serve a purpose. And so for those of you who may not be familiar with what this is, it's usually the same sponsor who sponsored the fund will create another fund specifically to purchase some or even one of the assets from an existing commingled fund. The easy example would be you've got one company left in a private equity fund, it's either not ready for sale, there's still work in progress to really maximize value, or just can't find the right buyer at that time, and it's just sort of lingering on the balance sheet of the fund. Instead of just continuing the fund indefinitely, seeking LP approval to extend the fund, the concept was born, well, let's just sell the asset to ourselves effectively, or some overlapping investor group with maybe some new money as well, and we'll create an exit shut down our commingled fund and give ourselves more time with this asset to realize the maximum value possible, hopefully, right? And that's actually great. That can work very well. Usually investors who are in the fund get the option of whether to roll into the new fund or not. They can cash out at that purchase price effectively, or they can, if they believe in the investment, they can continue on in the investment. Of course, a lot of this is contingent on whether financing is available, whether additional capital can be raised to actually realize that value. And there's the question as far as how many investors are going to roll and how many investors are going to want out, right? Because everybody wants out, the deal might not happen, right? So it's good in a lot of ways, but as the lawyer and talking to my clients, most of my clients do not like, vehemently do not like what has actually occurred with continuation funds. It's sort of the devil's in the details, if you will. But the things that they're not particularly happy about, and I'm hoping we can find solutions to these problems, because I do think the concept is a very good one. I just think it's broken in its present state. The first big issue that LPs have is it's kind of a gun to your head decision, right? It's like what's being presented are two bad choices. You can either cash out at a price that's probably depressed from what GP's been telling you this company's been worth all along. Or you can roll into a new fund, but rolling into a new fund does not come without costs. And so some LPs would say it really would just be better to extend the fund. And a lot of GPs aren't willing to do that. That's not a perfect solution either. The pricing can be suspect, right? We're talking about private assets, which are subject to valuations. If they had 1 million buyers lined up to buy these assets, they would have just sold. We don't have that situation, so you're having to get valuations. And I think everyone in here probably understands valuation is an art, not a science. And there's plenty of room for leeway here, and there can be misaligned incentives on where that pricing can come out. Depending on whether your existing fund is in the money or not in the money, and the carry and those sorts of things. And no matter what happens, the ultimate sale price of that company is not going to be exactly the same as the pricing when it gets sold to the continuation fund. So there's going to be winners and losers in that decision.
Certainly don't hope so.
Yeah, right. You don't hope so. Another issue that LPs are concerned about is the terms of the continuation fund are derived at a time when those LPs do not have the same leverage they probably had at the fundraise of the commingled fund. And so those terms might not be as good for them. There might not be key person clauses in the continuation funds, or they might be different. That's just one example, but there can be a whole host of things. These funds are not free. There is management fees and there is carry. Those terms may or may not be more or less favorable than in the original fund. There's questions about side letter negotiations and what do you get? Do you just get it if you roll over your same side letter or not? The funds are different, so there's added costs and time there. Who pays those transaction costs? Is it all the continuation fund? Is the buyer pays all the costs associated with the deal, or is it split between buyer and seller? Or does the seller pay all those costs? A particularly onerous thing that I've seen that I push back very, very hard on is waiver of claims. So we've seen if you roll into the continuation fund, the standard document that is the acceptance of that will contain a waiver potentially of all claims that an investor might have against the GP for all deals and anything that happened in the commingled fund, which I think is an incredible overreach. And of course, I push back very hard on that. Whether or not you're waiving claims with respect to the pricing of this particular deal, maybe that's an acceptable level of waiver, rather than, yes, I roll and then I'm going to turn around and sue you tomorrow, right? That might be an appropriate level of waiver. But the single biggest thing, and the thing that I think that we need to focus on finding a solution for, is the economics. This is the complaint I get from my clients over and over again, because if you just extend the fund, you have one waterfall for all those commingled assets. There's clawbacks if it doesn't. If this asset doesn't ultimately sell for much or goes bankrupt or whatnot, there may be a clawback on previously paid carry. And that's sort of the deal that everyone signed up for when they went into the commingled fund. But when you roll, what typically happens is you get this valuation. It's deemed to be sold at that price. If that price is a gain in over the preferred return, et cetera, of what the cost basis was, the GP can take carry at that time, and then you go into the new fund at that new basis, effectively. But then there's no netting. So let's say that happens, the GP gets some carry on that deemed sale, but you're rolling into the new fund. You're still in this portfolio company. You go over at that new basis, and the company goes bankrupt, becomes worthless. There's no clawback based on that carry that was paid in the prior fund. And so the thing that I would really, really like to solve for, and I think would make a lot more LPs more favorably inclined to continuation funds, is to, for those investors who roll over, to have a netting mechanism on that carry, because they signed up for a fund that's going to have 10 private equity companies in it. They were going to be held to around year 8, 9, 10, sold, et cetera. That's sort of what they were expecting. And that isn't what they got. Through maybe no one's fault, but to have the economics skew towards the GP potentially in a way that harms them when they ultimately may not realize, they might realize a loss on that company, and the GP still got paid carry on that company.
It's actually a little bit more complicated than that, isn't it, Scott? I mean, so let's just take a company that the fund's invested in, and it's doing well. The company's doing well. The fund's been in it for 6, 7 years, but Sequoia came in last year, and they put a large amount of money into this company. And obviously, they're not looking for it to exit in a year. They want to go 3, 4, 5, 6 years. So this company now has this long ramp that it's now on, and the investors in this fund, right, your clients are saying, hey, we want an exit now. But the fund can't effectuate that at the company level because Sequoia's come in with this large investment into it. And they're along for the ride now. So this is a way to sort of allow people to continue in that investment that want to continue, on those LPs that want to get out, way to get out. It's a great solution from that point, but you're bringing up all these other, issues that are there. So it's actually a pretty complicated scenario, providing, a fairly intelligent solution to a problem. And I think you're right; it has to be worked out a little bit on these different issues. So I guess we have
a client with that exact same scenario that you described, a fund client of our firm, that exact same scenario happened, and they can't get out because they don't have enough votes, to overrule the larger private equity firm who came in with a larger position that's really controlling when that company sells. I mean, they could sell to that firm at a huge discount, of course, but they don't want to do that, right? So yeah, look, it's not I'm not trying to paint this as white hat, black hat situation. I do think that they serve a great purpose, but coming from the LP perspective, there are concerns in the LP base about the potential fairness of this, and we've seen different things. Like we've seen situations. We've got this negotiated out of the fund documents, but as you probably know, a lot of commingled fund documents today are coming with pre-baked continuation fund language in them to allow this to happen, right? Because before it was more of a conflict vote situation. No one really knew who they had to get permission from. But we've seen funds come to market, managers come to market with LP advisory committee having the power to approve a continuation fund and drag every investor into the continuation fund. We've pushed back on that. That's like a new investment decision. Investment committee didn't approve. Like we can't agree to that. And I think we've been pretty successful pushing back on that. But that's sort of like the most egregious level of language we're starting to see. That's really an overreach. But most funds don't go that. Do
you think there'll be some language in the original PPM moving forward that will help control for this? In order for them to vote in a new round in a company of capital, that it has to be approved at the fund level or things along those lines, maybe so they don't relinquish positions? Or do you think that would be too cumbersome?
Yeah, I don't see it going to LPAC or LP votes as to whether your GP as an investor in a portfolio company, somebody else, some non-affiliate coming in. I think that would probably be too much control over the GP and their investment discretion. And I wouldn't ask for that or want to see that either. I don't really know how, other than through negotiating on the deal itself with that new money, as far as like some sort of exit rights or drag along rights that the minority shareholder could actually drag along the majority, or some other means of dealing with that, or shotgun pricing or something, shotgun clause or something with the larger firm. There are ways to deal with that problem. I think that not everyone is, you may not always be able to get that in negotiations, and maybe some folks hadn't really anticipated the problem being as big as it could be.
Great. Russell and Timothy, I'm curious, are you, I know Russell's invested in funds. I don't know if Timothy's primarily direct or if he invests through funds. But have you run into this situation? Have you been on either side of this conversation?
Yeah, I've actually got a couple of follow-up questions, but Russell, go ahead.
Yeah, I mean, I've actually been, I guess, my previous experience, even as a fund manager, we did have a extension, a continuation to do one or two further portfolio companies that worked out very well. So at that time, we actually had to get the approval. It was a super majority, I think, of 70% of the LPs, and we went through that process to do it. And it was a good thing about that we did it, because then we were able to work longer. And let's say you can say that some of these funds become a zombie fund, right? Walking dead, and there's no point. But I think that all LPs should be conceptually open to the idea, because you got to make a decision whether it makes sense, and you can evaluate that. And I think that the common language is that there has to be a vote on it, and a super majority, which I think is generally 70% of the LPs have to agree to that. So I have been on, even my previous life as a venture capitalist, I have been on that side. As an LP, I guess fortunately, our funds that we've invested in, I'll knock on wood, have always given us strong returns. So we haven't been in this situation. I think that I see that in the market. We don't anticipate, I don't think anything in our portfolio at the moment. I don't see any problems with this happening. And we want to have to take it on a case-by-case basis to evaluate whether it makes sense. It's all about returns and multiples and what you do. So that's kind of my, that's how I frame this conversation. But Timothy, I'm sure you could add something to it.
All great points, Russell. Just wanted to put a couple things out there. And yeah, as I was saying early on, we're about 35% in alternative investments now. Several things on the funds and the continuation vehicles bring up some great questions and follow-up points. And I think the consideration of the negotiating and making sure that LPs have the right type of vote are a critical thing. But I'm kind of curious from Scott's perspective, there's been a lot of questions or concerns about the PE fund's use of NAV loans at this stage, even prior to a continuation vehicle. Some cases even using it to return capital to LPs, which begs a lot of different questions and conflict of interests that could emerge from that. At the same time, they're levering up the portfolio at a time where there's a lot of uncertain dynamics. And I think that makes a lot of people uncomfortable. So I'm curious, as you go, both if you have an opinion on that, and as you negotiate continuation vehicles, are you putting more limitations on that? Because I feel like a lot of LPs were kind of caught off guard that was going to be a play that they would use in this type of an environment.
Yeah, absolutely. Many of my clients are very concerned with NAV loans, and I would agree with you. I have mixed views on NAV loans. I think there's definitely a use for them, a legitimate use. I don't think returning capital is one of them. You're definitely, robbing from Peter to pay Paul. And with interest rates being what they are, you know, if you could borrow for 1% or basically nothing to do it, that's one thing. But when you're paying, you know, 8%, that's quite another. But the funny thing is, you know, I've gone back and looked at a lot of older fund documents, and technically NAV loans would have been permitted, but they were never really enumerated, right? It was never clear. It's just, we have an overall debt limit of X. We can pledge all assets, you know, whatever. There's like subline language, and then there's just general debt, you know, fund level debt language. And then, you know, people started coming up with the NAV loans. I think that there is a use for them if all capital has been called, and you need and can get efficient financing for legitimate purposes. You know, whether it's some rescue financing or something like that. And for whatever reason, it makes sense to do it at the fund level, maybe way cheaper or something than doing it at the portfolio company level. So I think there's some legitimate uses for NAV loans, but I do think you have to be very careful. And I think that using it to pay back investors is, especially if it's not all investors, but even all investors, a very risky play that will, in more cases than we would hope for, end up being very bad. So
my thoughts exactly. And in this case, the question came up. It was kind of a private institutional roundtable. The question came up where, of course, part of them returning it was because it would help improve their metrics, IRRs, etc., which would help them get more incentives. And so it wasn't actually really in the best interest of the LPs, anyways, potentially. So a lot of conflicts seem to come from that may not be resolved. Just one last comment, because I know they're going to wrap us up, and just want to throw this out there for the family offices that are thinking about directs. Everyone's talking about private markets. Everyone's saying, hey, we want to get into more direct deals. And of course, the return profiles are better, but so are the risks are much higher. And so my advice to people is not every private equity fund will allow you to co-invest once you're an LP. But that's a great way to get co-investment exposure without trying to take on a deal in-house. I can't tell you how many family offices I've spoken to that have exposure to companies and they really don't know what to do with it, right? There's issues coming up and they're not equipped, or they don't have staff like us in-house to deal with these management teams. So I would suggest that a lot avoid trying to go direct unless either A, you've got the chance to co-invest with your private equity or venture capital manager, or have a good co-investment partner, but make sure that co-investment partner also knows what they're doing.
Yeah, I think co-investments are a great way to get some exposure to direct deals that have been vetted. Marty's is getting out the cane here, so I just want everybody to be on alert, but I want to jump over to Ben and just talk a little bit about some of the deals you've done and opportunities that you're currently looking for, so people really have a good focus on what it is you want to do.
I appreciate that, Mark. I'll try to make this brief, but I appreciate the comments of the panelists about a lot of these things. I'll tell you what my conclusion from some of the discussions that have come up is how flexible the alternative asset class has become. I mean, the fact that if there's no senior lending, there's private credit. If you are caught within a certain time frame of selling your company, you can do continuation funds or secondary funds. So, you know, the revolution or the evolution is awesome. And it's great to be part of it. The way that I find deals is I try to talk with founder, owner, first generation of companies. And the more I meet, the more I'm in those circles, the more I'm networking with those folks, and I hear about the companies that they start. So the first investment under NewOrigin Investments was backing a son to buy out the father of a family-owned business that is a manufacturer and franchisor of mobility devices. So these could be anything from wheelchair ramps to things that are used in the home, again, to increase the mobility of folks. And it had been in the company had been in the family for 20 years. Let's say 20 million of revenue, $3 million of cash flow. And it was a phenomenal situation to provide liquidity immediately, allow the family to continue in the office because obviously they continue in the company because they rolled over, and for me to be a part of that company as a growth majority investor. So if I could find deals like that all day, it'd be great. But as Scott mentioned before, some of them are too expensive. No matter how much I love the family or love the deal or can get their debt, I could show you the correlation between success and failure is the price that you pay upon purchase. Similar to the Russell's comment about Series A to Series C investing. The beauty of investing in the Googles or the Ubers maybe, or the Apples, is that at one point in time, they were pretty low priced. That helps. So as much as I meet founders and owners and companies, the more that there is incentive to invest with them at a certain point in time at a little bit lower price, which probably is earlier stage, the better that I have a chance to be success on IRRs.
Fantastic. Ron, I'm coming over to you. We're now on a lightning round here, so I just want to put you on notice for that. Leaving AI aside, because we did a lot of discussion on that yesterday, talk about fintech and the areas within fintech that you're excited about.
As I commented, I think and AI actually fits into that because the future is embedded finance, and embedded finance effectively allows you to have a cradle-to-grave ability to look at performance by channel, by asset class, by borrower, by servicing, and so on and so forth. And I think, we can all say in this room that we're all collectively underexposed to the global emerging markets. So we're definitely, America is under invested in alternatives and also severely underinvested in the new emerging growth being, India, Africa, and Southeast Asia. I think finance can bridge that gap where you can actually either be on the growth side of that, fintech. So you can be in a fintech just in tech alone. That means you're on a payment rail. I think that by itself, I'm not super excited about, because what happens is infrastructure is being continuously, it's a very competitive space and somebody will beat you to it. But if you're creating what is considered ultimately ability to compartmentalize these collateral and be able to offer and finance it using that information, so you're beneficiary of that information rail being better and better, faster and more reliable, and be able to get cross boundaries and build confidence. Everything I said has nothing to do with Web3, has 100% to do with the standard way, essentially you do internet-based lending, app lending, wallets, and ultimately that could lead to offerings that are fractionalized and allow people to transact faster at the final investment. But again, we see the world in that regard, whether it's healthcare, whether it's sustainability, whether it's trying to bring in solutions of water to Africa, reforestations. All of that may sound very remote to your world today, but you're going to keep hearing about it because that's what the world needs. And that's
Great.
what
I have to move on from there because we're down to our last minutes here. So,
sorry,
but thank you. I think you gave great insight. So it's really going to help bridge, and especially in the emerging markets. Timothy, I want to come to you and talk about energy, if you would. Your family has a history in it, and right now there's a big transition going on in that area. Tell me what you find exciting and what you're avoiding.
Yes, sir. Happy to talk about it. So we're about 25% exposure across all energy and all asset classes. So we've reduced that dramatically, mainly just from a diversification standpoint. But we're a big fan of energy transition opportunities. We're not doing early stage, but we are looking at a lot of ancillary business opportunities that fall into our private equity lens or can be kind of applied to private equity portfolios with kind of a tech-enabled perspective. So of course, there's a lot of dynamics happening on energy transition now too, like EV demand is definitely falling quite a bit, things of that nature. But you've got also other really exciting dynamics like natural gas is at really low valuations right now. It's also one of our best options for clean burning fuel in terms of scaling and expanding our power generation in our grid. So I think that there's huge opportunities if you look out over a 5-10 year period right now in natural gas. Low prices don't bother us. We hedge out our production, so we run all of our economics when we underwrite it. But it certainly makes for new opportunities to be able to take advantage of that. I'll also say that I think with the longer term perspective, investing in EV charging infrastructure, as well as certain rare earth minerals or critical minerals, I think still has a very unique proposition. That's one area that we're looking at very closely. There's very few operating rare earth or critical mineral type mines or so on within the U.S. And I think that poses some challenging issues longer term as these dynamics continue to expand and more happens in the energy transition space. Thank you again.
Fantastic. Russell, I want to use you as far as our discussion on sectors go. You have mentioned you invest in a lot of things: AI, deep tech, life science, healthcare, fintech, ed tech, med tech. Just off the top of your head, what are the top 3 or 4 areas that have your interest right now?
So, and I'll say this, sort of looking at my portfolio, the best returning fund at the moment, and co-investments go with this, is in a deep tech fund. We're on track to have a 10x return. We have a AI fund that's on tracking to do a 5x return. So I think those are very helpful. And then we're doing a seed investment, which is broader in terms of technology, but obviously there's an intersection between AI, deep tech, and other tech. So this is a more generalist fund, but it's more on a seed level, and that's also trending at a 5x return. So the 2 sectors that we're seeing, as I mentioned, deep tech and AI at the moment. But I would say it's not for novice. Be careful. 20 odd years ago, I started with a fund of fund. It is a co-investment in the top tier Silicon Valley funds. I then started investing in particular funds, then industry funds, and then in verticals, and then co-investments, and then direct. So it's taken me over 20 years to build out this portfolio, and always be very, very careful and diversifying, because as I think, as our panelists said, it takes a lot of time to get this expertise. It's spent a lot of time. I travel the world, networking, looking for fund managers, anywhere from Singapore, India, Europe, and throughout the US. And I think taking step by step in these environments, there's always going to be opportunities. We were very, very aggressive, active during the 2-3 years during the pandemic, because there were some very good technology firms and good valuations. And when things are not going, when there's a little bit more macro risk, then we take our foot off the accelerator, but we still continue to invest. And that's one thing I wanted to say. It's a long-term business. There's many, many companies and funds that did the best during the great economic recession or before that. And it really comes down to getting to know the people, spending the time, not with a huge sense of urgency, but a continuous process, because in the end, I invest in people who can execute much better than myself.
Excellent. Scott, you're going to get the final word here, and I would be remiss if we didn't touch on carve-outs and spin-outs. So I'd like you just maybe to talk about, things that family offices should be thinking about when they're considering those types of investments.
Well, before I do that, so I don't forget, Ben, I know a portfolio company in your space that's looking for growth capital, so you might want to shoot me an email after this.
5 minutes.
Okay. I mean, with carve-outs and spin-outs, you're talking about with existing portfolio companies, like sending off like the crown jewel, or what exactly do you mean?
Yeah, there's more and more companies are way to create some cash for themselves, are taking some, subsidiaries or divisions that maybe aren't core and essential to their business and saying, okay, we're going to, throw them off our books and spin them out. Or maybe, less egregious is doing a carve out, right?
Yeah, I mean, I'm generally in favor of it. I think, if you're looking to buy that, you have to make sure it can sustain itself, and like, what are the costs going to be as far as, what kind of agreements are there going to be between the old parent and the new company, as far as necessary services, support, etc., or can this new carved out, spun out company really stand on its own, right? What is it really going to take to be a viable standalone company? But I think there's great opportunities there. There's this cycle, right, of amalgamation, and then breaking it up, right, to find the most efficient capital structure, the most efficient. Is it all done in one, or you have the verticals and horizontal integration, or is it really better standalone? Is it distracting? Do you have like the CEO of this company that's spending 80% of his or her time on 10% of the overall business? That's not efficient, right? Spin that thing out, let somebody else take care of that. Or even if this is the right person, have that person go that way and let the other company stand alone. So I think there's potentially great opportunities there, but it's very case by case basis, right? If you're just selling off, assets or business lines simply to raise capital because the mothership's in trouble, you got to be very careful, like when looking at that situation.
Well, terrific. Appreciate that. And I really want to thank our whole panel. You guys were fantastic. I wish we had another hour to do this and continue our conversation, because I think there's so much more we could discuss and handle. Marty, thank you for this opportunity. We'll turn it back over to you now.
Thanks, everyone. Enjoyed it.
Thanks, guys.